There's a number most retirees have never heard of: zero. If you're 65 and married, the tax code right now lets you bring in more than $140,000 this year and pay zero in federal income tax. This isn't a YouTube tax guru loophole. It's the standard deduction, a new senior tax break most people don't know exists yet, and the 0% capital gains bracket stacked on top of each other. I'm PJ Gibbs, a financial advisor and the founder of Trello Wealth. And on this channel, I help people in the decade before retirement figure out how to keep more of what they've already earned. What I want to show you today is the exact math behind how this works, the three income buckets you need, and the reason chasing that $0 number can actually cost you more later if you're not careful. The first piece of this is the deduction stack. And for a married couple where both spouses are 65 or older in 2026, it's bigger than most people realize. First, the standard deduction for married filing jointly in 2026 is $32,200. Second, if both of you are 65 or older, you get an extra $3,300 on top of that, $1,650 per spouse, which is the age 65 additional deduction the IRS has offered for years. Third, Congress added something new for 2025 through 2028 called the senior bonus deduction, $6,000 per qualified individual age 65 or older. For a couple where both spouses qualify, that's another $12,000. Stack those three together, the $32,200 plus $3,300 plus $12,000, and you get $47,500 in total deductions before you've spent a single dollar of income. That effectively erases the first $47,500 of your ordinary taxable income completely. Pull that amount from a traditional IRA this year, assuming you're married, both 65 and filing jointly, and your federal income tax on that withdrawal is zero. Now, the senior bonus does phase out. It starts reducing once your modified adjusted gross income hits $150,000 at a rate of 6 cents per dollar above that threshold. And at $250,000, it's fully gone. So this only works cleanly if your income stays below that $150,000 line. We'll come back to why that matters. And I want to flag something important here. This senior bonus expires after 2028 under current law. Whether Congress extends it is its own conversation. But right now, for the next 3 years, it's real, it's available, and most people aren't planning for it. The second piece is the 0% long-term capital gains bracket. And this one is a little more counterintuitive. For those who file married filing jointly in 2026, the 0% rate on long-term capital gains and qualified dividends applies as long as your taxable income stays at or below $98,900. Taxable income, not gross income, meaning after your deductions have already been applied. Here's what that actually means in real life. If you've already used your $47,500 deduction stack to zero out your ordinary income from IRA withdrawals, and then you receive long-term capital gains or qualified dividends from a brokerage account, those gains are measured against your taxable income. If your taxable income stays under $98,900, those gains are taxed at exactly 0%. This is the magic threshold. $47,500 in deductions plus $98,900 of 0% capital gains room gives you a theoretical ceiling of $146,400 in income this year with zero federal income tax owed. But I want to be careful because that ceiling is not a target, it's room. And how much of that room you actually need depends on what you actually spend. Filling it just to fill it without a clear reason might create its own set of problems. That's the nuance we'll get to shortly. Okay, to actually execute this strategy, you need income coming from 3 specific places. Most people have 1, maybe 2 of them. The ones who pay 0 have all 3 working together. Bucket 1 is your traditional pre-tax accounts, your 401k, your traditional IRA. Distributions from these are ordinary income, meaning they're taxable. But they're also the ones that get absorbed by your deduction stack. You pull up to $47,500 from your pre-tax accounts, the deductions cover it, and you don't owe a thing. Bucket 2 is a taxable brokerage account, where you hold investments that generate qualified dividends or long-term capital gains. Stocks held for more than a year, dividend-paying index funds, those kind of things. These don't get wiped out by the standard deduction, but they do qualify for the 0% capital gains rate as long as your taxable income stays inside the bracket, up to $98,900 from this bucket as zero federal tax, provided you structured the rest of your income correctly. Bucket 3 is your Roth. Roth distributions in retirement are tax-free, but here's the part you probably don't realize. They also don't count towards your modified adjusted gross income for purposes of the senior bonus phase out or the 0% capital gains threshold. You can pull from a Roth, and it's essentially invisible to the IRS's income calculations for those purposes. The Roth is your flexible spending bucket, the account you reach for when you need extra money in a given year and don't want to push income into a phase out or a higher bracket. It's also the hardest bucket to build quickly, which brings us to the math. Picture a couple that we'll call Mark and Carol, both 65, married filing jointly, and for this purpose, we're going to assume they live in a state with no income tax. They've done a great job and saved $2.2 million, $1.6 million of it in pre-tax retirement accounts, $500,000 in a taxable brokerage account, and $100,000 in a Roth IRA. This year, they need $95,000 to cover their actual spending. Here's how they pull it. They're going to take $47,500 from their traditional IRA. That matches their full deduction stack exactly. $32,200 plus $3,300 plus $12,000. Federal income tax on that part? Zero. From their brokerage account, they're going to take another $47,500 in a combination of qualified dividends and long-term capital gains. Their taxable income at this point is still zero because the deductions already wiped out the ordinary income. Those $47,500 in capital gains sit against a zero taxable income base, well inside that $98,900 ceiling. So their federal capital gains tax is also zero. Total income so far is $95,000. Their total federal income tax, zero. But say they need an extra $5,000 for a home project and their income actually was at that $98,000. Then they can pull it from a Roth. Tax on that would be zero, and it doesn't move their modified adjusted gross income at all. Now look, this is a hypothetical example just for illustration purposes. So there's other factors that need to be considered as well. So that's the structure. 3 buckets coordinated so each layer of the tax code cancels out a different slice of income. It's not complicated, but it requires every piece to be in place before you need it. Quick question before we keep going. Have you ever actually modeled what your retirement income picture looks like by income source? Tell me in the comments. It helps me know how deep to go on these scenarios. Now, this is the part almost nobody talks about when they share this strategy, because what I just showed you works beautifully when you control how much income you take. The problem is that eventually you won't. At age 73, the IRS requires you to start taking required minimum distributions from your pre-tax accounts, whether you need that money or not. This uniform lifetime table factor at age 73 is 26.5. On Mark and Carol's $1.6 million pre-tax balance, that first RMD comes out to approximately $60,000. That single number already exceeds their entire deduction stack of $47,500, which means $12,877 of that distribution is sitting in taxable ordinary income territory with no shelter. And the RMD grows every year as the account, hopefully, continues to grow. But that's not even the compounding piece. Once Social Security enters the picture, which we haven't included in this scenario at all, the income stacking problem gets worse. Social Security benefits become partially taxable once combined income crosses $32,000 for married filers, and up to 85% of your benefit can become taxable above $44,000. Now, your $0 tax picture looks very different. Research from the Center for Retirement Research at Boston College shows that most retirees significantly underestimate how much of the retirement income will ultimately be subject to taxation, primarily Because RMDs they didn't plan around. That's not a small oversight. That's a decades-long compounding mistake dressed up as a paperwork problem. The people who actually pay zero in retirement didn't figure this out at 65. They figured it out at 52 or 55 or 58. They spent a decade before retirement doing Roth conversions specifically to shrink that pre-tax balance, moving money out of the account that was going to generate mandatory taxable income into the account that wouldn't. They bought themselves room before the IRS started dictating the terms. So let's be honest about what this strategy actually is. The $0 tax outcome in retirement is not something you execute at 65. It's something you build towards in your 50s. The 10 years before you stop working, what I think of as the transition decade, are when the architecture of your retirement tax picture gets set. In those years, a few things tend to be true. One, your income may be lower than your peak earning years, especially if you've moved into consulting, a reduced schedule, or have stopped maxing contributions at the same rate. Lower income means a lower tax bracket, which makes Roth conversions cheaper. You're prepaying taxes at a discount, so the money grows tax-free and never becomes an RMD problem. Two, you have time to build the brokerage bucket in a tax-efficient way. Taxable account filled with appreciated long-term holdings doesn't get built in a year or two. It takes the kind of consistent, low-turnover investing that rewards patience. You can't manufacture that at age 64. Three, this is the window to actually model what your income picture looks like at 65, 73, and 75. What does your Social Security benefit look like at different claiming ages? What does your RMD calculation tell you about your pre-tax balance at 73? If those numbers stack up in a way that blows past the $47,500 deduction ceiling, the Roth conversion work needs to happen now. Morgan Housel in The Psychology of Money makes the point that the biggest financial decisions aren't really about returns. They're about time and optionality. The zero tax retirement isn't about being clever at 65. It's about protecting your ability to make planning decisions in the decade before you get there. Every year you don't convert, you narrow that window. Every year you do, you expand your room. I'll say this plainly, that room doesn't roll over. The 0% bracket, the senior bonus deduction, the Roth conversion window, you either use them in the years they're available or they're gone. That purpose and drive to protect what you've built has to be deliberate, not reactive. So here's what we covered. The 2026 deduction stack for a married couple, both age 65 or older, totals $47,500. The 0% capital gains bracket covers up to another $98,900 of qualified dividends and long-term gains. And Roth distributions sit entirely outside both calculations, which means the theoretical ceiling for zero federal income tax this year is $146,400. But that ceiling is only accessible if you built the three buckets well before retirement. And the RMD clock at 73 starts collapsing that room the moment you stop controlling your own income draws. If you want to find out where you actually stand, whether you're on track to use this kind of room or whether the RMD math is going to catch you off guard, the Retirement Readiness Scorecard, which you can find in the link in the description, is a good place to start. It's a straightforward way to see the gaps before they become expensive to fix.